Welcome to our deep dive into the concept of crowding out. Today, we'll explore how increased government spending can impact private sector investment, a fundamental topic in macroeconomics. First, let's define crowding out. In economics, crowding out refers to the phenomenon where increased government spending leads to a reduction in private sector investment. Essentially, when the government borrows more money, it can drive up interest rates, making it more expensive for private enterprises to borrow and invest. Let's look at an example. Assume the government decides to fund a new infrastructure project. To finance this, it issues bonds. The increased demand for loanable funds raises the prevailing interest rates. Higher interest rates make borrowing more expensive for businesses, which may then delay or cancel their investment projects. To better understand this, we'll consider the supply and demand for loanable funds. Typically, the interest rate is determined by the supply of savings and the demand for loans. When the government enters the market to borrow more, the demand curve shifts right, leading to higher interest rates unless there is a corresponding increase in the supply of savings. Consider this hypothetical data showing the interest rates before and after a government spending spree. Now, let's go over some questions to test your understanding. Question 1. What is crowding out? Pause the video and try to answer. If you answered that crowding out is where increased government spending leads to reduced private sector investment due to higher interest rates, you are correct. Question 2. How does increased government borrowing affect interest rates and private investment? Pause and reflect. The correct answer is that increased government borrowing raises demand for loanable funds, which drives up interest rates, subsequently reducing private sector borrowing and investment. In real-world scenarios, the extent of crowding out can be affected by various factors such as the state of the economy, public confidence, and monetary policies. For instance, in a recession, when private sector demand for funds is low, increased government borrowing might not lead to significant crowding out. Conversely, in a booming economy, the effect can be much stronger. Let's analyze some historical data to see how crowding out has played out in the past. Notice how private investment growth slowed during periods of increased government borrowing and spending, demonstrating the crowding out effect. Another key point to consider is the role of central banks. They can counteract crowding out by increasing the money supply to keep interest rates stable. For example, during the 2008 financial crisis, the Federal Reserve engaged in quantitative easing to maintain low interest rates despite high government borrowing. So, does crowding out mean that government spending is always bad for the economy? Not necessarily. If government projects boost overall economic productivity or fill critical infrastructure gaps, the long-term benefits may outweigh the short-term crowding out effects. Therefore, the context and nature of the spending play crucial roles. To sum up, understanding crowding out helps policymakers and stakeholders make informed decisions. By considering the trade-offs and actively managing interest rates, economic goals can be balanced more effectively. Thank you for watching this in-depth tutorial on crowding out. Don't forget to like, share, and subscribe for more insightful videos. Until next time, happy learning!